Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much.
What is going on, DeFi Slate fam? Welcome back to the DeFi by Design podcast. Super stoked to have Weso from Beefy Finance on the podcast today. And we're in the midst of some choppy markets, but builders build. That's really why we're here, and continuing to provide value to the ecosystem overall is Beefy Finance. And we're going to dig into what Beefy does, how they contribute value, and some of the newest updates that are coming out really at some of the cutting edge technology in DeFi, right? Beefy is they're a multi-chain optimizer, which of course you've heard us preach about the multi-chain several instances over here. So when you're a profit maximalist, you're not really specific to one of these chains. You're kind of looking to drive the most value possible out of all these chains, and Beefy helps to drive that value. So I'm going to pass it over to Weso for a quick introduction, and then we'll dig into everything that Beefy has to offer there. What's going on, Weso?
Hey, how's it going? Well, yeah, thanks for having me on. So I'm in charge of strategic partnerships. I'm also one of the lead devs over at Beefy Finance. So I've been part of the DAO since February of 21, so just over a year now. And Beefy itself is about a year and a half old, so one of the OG DeFi products, especially in the multi-chain world, since we launched when BSC pretty much, immediately when BSC launched to optimize all those farm yields over there. So, but it's been fun. So, yeah.
Solid, yeah. Binance Smart Chain had pretty immense APYs that were going on at one point, and those have tapered off a bit. I think kind of as the overall market is starting to recede. People are more risk off nowadays versus a year or two ago when there was a flurry of flaming hot ball of money that was flying all over the place, and the incentives were super high, and they were incentivizing most of these pool twos just out the wazoo with token emissions, and farming was very profitable just by sitting in these pools, usually taking some risk by having exposure to one of those sides of the LP. But then ultimately the emissions would pay off for any decline in price of those assets due to inflation or generated emissions. So, optimizers and kind of auto compounders are something that we've seen, really across a lot of these different chains. Like, it seems like the starter kit to launch an L1 ecosystem at this point is you get your Uniswap clone, you get your DEX, you get your lending and borrowing ecosystem, give it 𝗷𝗍 or 𝗵𝗀𝗃 on Avalanche, or, what have you. And then the third, and a little bit less, I guess, utilized, is this auto compounder yield optimizer sort of application that we've seen yearn on mainnet, some other instances on some other chains, and Beefy is providing that, really, starting from Binance but branching into several different chains. Could you unpack kind of the strategy of launching one of these yield optimizers? You guys were one of the first ones to do it. What were some of the trials and tribulations of launching that protocol, and what you've learned over the course of a couple years now of a mainnet app in production?
Yeah, so we originally were a fork of Yearn V1, and so we went over and launched on BSC. Initially was because of all of the crazy farming that was kind of going on there. So, PancakeSwap launched. There was a whole bunch of DEXes that were launching. I think Venus launched as a lending protocol. And so there was an opportunity there to really maximize the emissions by, doing the auto compounding. So, deposit your LP token into Beefy. We sold the cake for more of whatever the LP is, added liquidity for you, and deposited it back into the farm. So creating compound interest. And I mean, at the time when the yields were crazy, I mean, the APYs were insane. And so that really kind of got everything kick-started, right, on BSC. It was really just a project to, I think personally, the initial developers just wanted to actually just compound for themselves, right? It's like, okay, well, now we can do this as a service as well. And because back in 2020, ETH was like super expensive to do anything. So there's a lot of like awesome innovation happening. Comp initially launched, the comp token and incentives for their lending product. Yearn was kind of doing its thing. Uni launched, the Uni token. 𝗪𝗎, did their version. And so all of a sudden there's like all these awesome things happening over on ETH, but then farming was just like super expensive. So, you wanted to lean on like an optimizer because then you didn't have to pay for all the gas of doing all the manual, optimizing yourself. But then BSC launched, right? And it was like, wow, like this unique opportunity to like really kind of take advantage of all this money rushing into, a cheaper transaction chain. And so, we developed there, and obviously for like, I think the better part of the beginning of 2021, the ecosystem was exploding. So there was, different DEXes popping up. There's different protocols. We saw algo coins. We saw, we did a lot of like lending services, even like services like Belt popped up. So we were able to optimize their yield. So like all of a sudden, all these new products were popping up, and there was all this opportunity for us to, do our thing on top of those protocols. And then, it went through that cycle of, boom, bust. And all of a sudden, I think once some of these other opportunities, these other blockchains started to pop up, it was like all of a sudden you see the TVL, right, starts to shift, somewhere else. So then we saw Avalanche launch in I think we actually launched an Avalanche in April of last year, and Polygon. And you saw at least initially there was a pretty decent size launch of, at Polygon. And there was the whole Iron Finance thing, and we built on top of that. And then there's this gigantic chasing of these really high yields over on Polygon. So, we kept developing as a product. And what we realized is that you can't be completely dependent on one chain, especially if you're going to be in these alt chains, right? These non-ETH chains, and you're going to be a non-ETH product. You have to be multi-chain. You saw a lot of products that built on BSC last year had initial success, and if you look at them and they're not a multi-chain product now, their TVL is 1/10, 1/20th of where it was, and it's really impacted the protocol. We made a decision early on to be a multi-chain product. So we launched over on Avalanche, we launched over on Polygon. We actually got a whole new user base over there, people that weren't on BSC. And we were able to become one of the larger, players in those specific networks. Then we launched on Fantom, and we continued our evolution, basically in wherever the opportunity was. So these new blockchains that are popping up, we ended up being part of the core, DeFi products, right? So like you mentioned, there's lending, there's DEXes, and then there's the optimizers, right? The auto compounders. I think of Beefy as we're a middle layer DeFi product. And that's what we kind of established ourselves now. So there's this first layer of you have decentralized exchanges, right? And you have lending protocols like 𝗵𝗶𝗴𝗵, or any sort of other ones that are producing emissions. And so then we built on top of those protocols, and now we optimize those yields. So you're always earning more of whatever you deposit. You're getting compound interest. And then the best part is you get this receipt token. So we call them 𝗵𝗶𝗴𝗵 tokens. But it's essentially your receipt for your share of whatever the vault is. Well, the receipt token can be essentially interest-bearing, an interest-bearing token. And so now we're seeing protocols built on top of us and using our receipt tokens for all of these different unique opportunities. So, we have a partnership with, a cross-chain partnership with Beefy Finance, or 𝗬𝗏. And so they're using our 𝗵 tokens as collateral. So now you have this interest-bearing collateral, right? So you're borrowing at 0% interest against your interest-bearing collateral, which is sort of like a self-repaying loan. So we're seeing all now these unique interactions with our protocol on top of us. So when we go and we talk to all these different networks about, hey, does it make sense for Beefy to get launched there? And a lot of them are reaching out to us saying, hey, like, we'd like to have, Beefy built in our ecosystem. Really we're that kind of like middle layer protocol, which is like developing now this like interest-bearing product. And then now, others can, build on top of us. And so that's where you start to see really, I think, like the money Legos start coming into play. And now we're going to see, I think, even further along in 2022, 2023 as we get into next year. There's all these innovations, and now people are building on top of everybody else. And so you're going to see all these really unique opportunities. We've already actually, I think, if you really wanted to look at all of the crazy DeFi opportunities that are possible, look at the stuff that's happening over in Fantom. There's just so many opportunities to earn tremendous yields over at Fantom. The Solidly launch was a new product that gave us a lot of opportunities, and obviously that is going through its own issues. But I think that you're seeing a lot of like the protocols building on top of each other and being able to do a whole lot of things over in Fantom. And so we're hoping that as we go to all these different networks and all these different blockchains, we can be a part of that, I guess, like building of the different ecosystem and having all these interaction with all these different protocols to, build on top of them and be able to optimize their yield, but then have people build on top of us and be able to utilize Beefy. Yeah, mute.
The lines between application and protocol are increasingly blurred. To me, protocol always meant, okay, it means that you can build on top and kind of it's kind of at the base of the tech stack, and you can build some applications on top. But now we have applications that provide a base layer for other applications to build on top of. And like you're saying, this points to the money Lego picture as more complete than bifurcation between protocols and applications, since even an application that might be 2 or 3 Legos up, has a set of like nubs on top that you can go stack another Lego on, be it an application or some other platform, and that leads to more scalability in terms of vertical integrations, horizontal, and so on, which is I mean, it's really bullish, right? For all the composability that is possible in the ecosystem, because we don't really know what applications are possible until the more primitive one gets built. And then each time, that new one is deployed, it opens up a new realm of possibilities for all the different new primitives that could be stacked on top of that recently built Lego. I think composability and scalability are really the takeaways from kind of this increasingly complex network of applications that ultimately has more niche use cases and kind of deeper depths that someone can dig into and generate income and increase their capital efficiency. You brought up a very timely issue, or whatever you want to call it, about Andre and the kind of devs leaving, and even some pretty recent applications that they built over on Fantom, but it doesn't seem to have phased your perspective on the yields over at Fantom and the opportunities there. What's your overall take on Andre and his partner leaving the ecosystem?
Andre probably just felt what like all of us as developers feel. Right? You put a lot of like time and effort into building a product, and people expect it to be like 100% perfect right when you launch it, and that's just not, I guess, fair to the development team. We're trying our best to launch new innovation, and what Andre built with Solidly was important because it basically decentralized the process of incentivizing liquidity pools. So, like right now, if you're a protocol and you want to launch, let's say you want to launch your token on PancakeSwap, right? And you want to incentivize that LP, you pretty much got to go to Pancake and be like, hey, how much is it going to cost me? And then they can go ahead and, set some missions aside for, that specific LP. And Solidly was supposed to like, get rid of that, right? Like basically like it decentralized that process where the voters, themselves were the token holders, and then, based upon, which LP position you voted on, you actually earn the trading fees for that gauge. And so it was supposed to incentivize people to vote correctly based upon trading volumes. And so it's like, it was an experimental piece of software that he, clearly wrote that it was an experimental piece of software that had issues. And I feel like he got so much hate because it didn't work right. It was like, basically, hey, I don't have to deal with any of this. And so I guess that's where, as a developer, right, you kind of feel that sometimes because we're trying to build, we're trying to create, and we don't get any leeway, So it's like, okay, well, things don't work 100% how they're supposed to. You hear about it. And I think, that gets tiring after a while, and I think you kind of get burnt out. So I think that's kind of what happened. But overall, like that Fantom ecosystem is still exploding. So to say like, oh, well, one person leaving really is going to make it a huge difference. It's kind of short-sighted. There was still a lot of things that were developed even before Solidly was even announced that it was going to launch. And we're still continuing to build. I mean, I know specifically all of the devs in the Fantom ecosystem, and they're all really engaged in continuing to build and, create innovation and more opportunities. And I think, all Solidly did was really increase attention to the ecosystem. You saw the TVL, skyrocket since the announcement of all of that. And then, there's obviously a bunch of protocols that are kind of like going in there to like, vamp the rewards. But in general, like a lot of that money that was over on Ethereum, went to want to go play in the playground that is Fantom. And so, that money really hasn't left. That money still wants to be there, still wants to play around in the innovation. And I think, Fantom themselves has put a very lucrative incentive program for people to build there. And there's still going to be people building there to get the incentives, but there's money there. There's people that want to play around in the innovation. So I think that there's still like, a ton of opportunity in Fantom. I think the same with, I think Polygon's doing, trying to do something similar. They're doing a TVL based incentive program. Avalanche still has its core builder base. So I think there's a lot of opportunities in some of these chains, especially with the incentive programs that they're kind of putting up now.
Are there any L1s that are up and coming that have an incentive program that's very lucrative for developers?
They're all starting to. So what happened was Fantom kind of like set the standard, right? It ended up being like not just lucrative, but like super lucrative incentive program. So if you can build there and you can grab TVL, you're going to get paid for it. What they noticed, I think, with all these other, not even just L1s, even L2s have noticed is that if you want people to come and the ecosystem to really kind of thrive, you have to incentivize it. And so people are playing around with a whole different, kit of ideas, right? So some of it's, okay, we'll base the incentives on TVL, like Fantom did. Some of them are like basically transaction mining. So you submit your core contracts and we'll monitor for the amount of transactions and we'll pay you a rate based upon the amount of transactions that your contracts are, processing. And then, some of them are grant funding, which is, I think, kind of like the past, right? It's kind of, hey, here's my idea. Let's go write it up and then submit it to a few people who decide whether or not they think the idea is any good and whether they should give you funding, which there's a lot of politics in that. And so I think, those who traditionally leaned upon grant funding as like a way to incentivize their new protocols have seen people kind of shy away from it. So I think they needed a more KPI led program in order to really kind of sustain a good ecosystem of new products.
Yeah, and ultimately, it's a centralization risk, right? Like these grant programs. There's also, you know, the bureaucracy of getting approved and whatnot. And Web3, it's
right?
like, yeah, build it and they will come. Like there's no blockers that need to be introduced kind of artificially. If the money's there, there's incentive structures that are capable through smart contracts that can be initiated in a decentralized way, which removes a lot of the, I think, bureaucracy from several different systems. Grant programs being one of the most prominent in DeFi. You mentioned KPI-driven incentive mechanisms, which seem to really generate some more. There's some interesting use cases coming out actually from Universal Market Access UMA that are introducing some KPI options tokens, which I think will be really interesting for
cool.
incentive structures. Yeah. And if an L1 utilizes those for an incentive structure that allows anyone to claim some of the treasury of an L1 or an L2, like you mentioned, it could really bootstrap an ecosystem and fuel growth.
Yeah.
Which is, super exciting that even though it seems saturated to the gills, right? Like all these L1s, all these L2s and chains.
It's going to get worse.
But if a better incentive structure comes along,
Yeah.
And correct me if I'm wrong on here, because I'm not in the depths as deep as you are in programming and leading a dev team, but my take is that developers and builders are just as unsticky as a lot of this liquidity, right? Like we see a lot of mercenary capital flowing around. If there's better incentives on a different chain, the liquidity will flow there very, very quickly. Are developers and builders kind of the same way? If there's an incentive structure that is more lucrative to build on a different layer 2, will projects migrate or builders abandon some of their projects and go rebrand on a different chain? Have you had an experience with some of those shifts in strategy?
Yeah, you know what's funny? So Beefy is fine. Like Beefy is a multi-chain product, and we're one of the larger ones. So if we build on something, we're gonna sustain it. So we'll be there trying to continue to build. Trying to launch new vaults, trying to make new partnerships with projects. But I think that there are ecosystems that they kind of built up and they had maybe a little bit of a run, and so you had some developers there that maybe launched a AMM or I don't know, some other protocol, and it just kind of now it's kind of flailed out, right? Because it's the money's left and went somewhere else. And you'll see them go and probably abandon those protocols and go build somewhere where either there's more money, so there's more TVL, or there's better incentives. I think you're going to see even more increasingly is the amount of L1s and L2s that are coming in the next 3 months or so, 4 months, and so it'd be interesting if they even are. Where's this money going to come from? So I think it's important, we're talking to a lot of these L1 and L2s that are just kind of launching, and it if you've been in crypto since 2017, it's some of these tokens that you heard of, you just didn't know what they actually did because you maybe just saw them on Binance or something, and all of a sudden now they're launching as a layer 1 or an EVM version of whatever they were trying to build, and so then they're trying to okay, well now how are we going to get all this, TVL over there? And some of them just aren't going to succeed because they're all competing at once. And, there's still obviously the ones that are existing that are competing, and there's still ETH. So, where's all this money going to come from? And so I think what's important to a lot of these L1s and L2s is to get really brand recognized protocols to come and build. Because their feeling is that if they can get a couple legit protocols, if you can get a Curve, if you can get Beefy, if you can get 𝗵𝗶𝗴𝗵 to come and build in your ecosystem, it sort of legitimizes your ecosystem. And so we've seen a lot of that. Is that there's a lot of competitiveness of these different L1s now saying, okay, well we need these big name, brand name protocols, because if we just have a few, like 3 native protocols that are building here, no one's going to really pay attention to us. So it will be interesting to see how, I think, over the next few months, one, like some of these already like established, like Moonriver, right? Which was a Kusama EVM, which really was like what, I guess, like testnet for Polkadot's, Moonbeam. I guess it's assumed that that one's going to exist on itself, and it's going to, supposed to be its own ecosystem. What we've seen is like a lot of the money's left there, and we don't see a whole lot of active development. So what's going to re-engage those people to continue to build there? And, what's more engaging to build there, or do you want people to build on Moonbeam, which is actually the Polkadot EVM or parachain? So I think there's like a lot of these like existing ones that we're going to see, okay, well, if the CDL's sort of kind of left and the developer talent's kind of left, where does that kind of leave them? What are they going to do if they've already ran an incentive program? How are they going to re-incentivize people to build there? Or is the change just going to kind of, die out? And then, will that happen with some of these new launches? Will there be like an initial rush? Okay, well, now there's like this money flowing in because there's developers, because there's funding for these developers to build there. But once like that kind of like initial funding or initial, boom kind of like, shakes out, what's going to happen? It's the same thing with BSC. BSC is kind of going through it right now. It's like, what do we do? How do we get people to come back and build on BSC again? Right now, it just seems like as a developer, it's just so much more exciting to build everywhere else. So, I think they're trying to figure out, I think they relaunched themselves as BNB chain. So they're trying to go through like this re-imaging. They're trying to do, a different incentive programs. They're trying to re-engage the builders that are inside the ecosystem. But they're going through what I think a lot of these other chains are going to go through is, okay, after your initial boom and the money sort of left, like, what are you going to do? How are you going to get that money back? So I think we've seen it already with some. We're going to see it, with the new ones, and we're going to see with some that are like currently, I guess, within their, boom cycle, right? Like, I think Fantom did a good job because it created a whole lot of excitement. Avalanche has its own, I think, kind of like maxi crowd. But what happens if the money or the developers start leaving? How do you get them back?
Yeah. The chains that have started to build kind of their own maximalist crowd could see a bit more sustainability than, the ones that were really just popped up for another instance of L1 to generate some money velocity, generate some flow back and forth, and just kickstart the cycle one more time, kind of like, throwing the wheel of fortune flywheel, kind of getting it spinning and ramped up again on another chain with a fresh batch of incentives. We're seeing a lot of that liquidity dry up and migrate back to the chains that have sustainable incentives. And I heard a great analogy in Lisbon for ETH Lisbon, and it was comparing, because the question here is really, when these incentives dry up, what happens to the liquidity? And it was a comparison to Uber Eats incentives, kind of when Uber first started. If you referred a friend, you could get, first it was $15 off your next order, and then it was $10 if you referred a friend, and it was $5. And now there's no incentive. Everyone knows Uber Eats. Everyone's familiar with it. If you frequently use it, you get what you get, and it does provide a service, but there's not an incentive to continue attracting new users to the service. And it brings a question of, to me, does it require new money entering the system to kickstart the flywheel again and provide a fresh batch of incentives? Or is there latent value that is kind of discovered and created and brought to the surface that enriches a community, is able to provide value that wasn't tapped into before, and doesn't require new money flowing into the system, but actually taps into a previously unknown source of value that, again, can kickstart the flywheel without a new entrant and fresh money into the system.
Yeah, I think the incentive piece is something that a lot of these, I think, networks and protocols have to kind of figure out. Think about pretty much a lot of these decentralized exchanges go through this like initial launch cycle where, I mean, the APY is like insane, right? Like you like 2-3 weeks, after launch, it's like, I think we had something that was like 1 billion % APY or something like that. Like it was a couple percent a day.
Yeah. The ones on Harvest where they were all compounding, like just the numbers wouldn't fit on the screen. And then within a week or two, it dwindles down into, 1,000%, but it wasn't the 10 trillion that it was previously.
Yeah. And so you have like those, like, initial, like, let's say 3 or 4 weeks that, liquidity comes and farms it. Like it's like heavily, right? And they're only there really to take it and sell it for whatever they're trying to farm. Basically, we'll do what we do, and that's why they utilize us a lot. Is they just want more with a deposit asset. Nobody really wants the DEXes governance token. And the reason, if you look at all the charts of like DEXes and their governance tokens, a lot of them, especially when they're high emissions, just keeps going down, right? Because there's just this constant sell pressure. So I think a lot of protocols are trying to figure out, okay, well, how do we kind of offset this emissions, because obviously we want our token to succeed, but if we scale back emissions, then we lose liquidity, we lose TVL, and so there's that's a growing pain right now, I think, for a lot of the exchanges and a lot of, I think, protocols, right? Because if you want to incentivize people to use your protocol, right now you have to have some sort of emissions, and people are going to go use the protocols that have like the best emissions. So I think we're going to start to see more. Beefy, we don't have any emissions. We just build on top of other protocols. But what we do is we share our earnings, right? So our fee structure is, for all of our harvests, we charge 4.5% fees, which is some of the lowest in all the ecosystems. But 3% of those fees, of the 4.5%, goes to basically an earnings pool. So if you have Beefy, you could stake it and you can earn a portion of the protocol earnings. So we're net positive in earnings. We have 0 emissions, and we just distribute all of our earnings to our stakers. I think that a lot of these protocols, you're going to have to start doing that, right? It's not going to be like, okay, well, the protocol just keeps all of the earnings themselves. They're going to need to be able to distribute their earnings to incentivize the continued use of the protocol, and start to offset some of the emissions. So then it's like, I think you're creating a positive loop. The more, use of the protocol itself, the more earnings the protocol is getting, the more you can incentivize the liquidity on the protocol. So that's where you have to kind of get into that, I think. But these like high emissions where they're just kind of printing something out of like thin air, and then has initial value, but as you continue to print it and the supply continues to expand, it's like, it starts to get dumped into the ground, and then people just don't know how to get out of that basically downward spiral that they're in. But I mean, it's something we have to. Even networks have to figure it out, right? Like you have to. You got to continue to incentivize your use of your network or people to build on there without giving out gigantic grant funding or incentives. So how do you do that?
Yeah, that's where men are separated from the boys, and you have these sustainable projects that are net positive. In if you take your emissions as an expense, and you take your income from the value that's generated by the service, you can generate a cash flow positive type of strategy. And I don't know the percent. I'm going like north of like 80 or 90% on the ones that are not cash flow positive.
No,
since Yeah, you can go 95% of these projects are like heavy emissions, tons of inflation, and not generating real value from their service. It's all the staking revenue from those emissions, and it's a consequence of the times, I guess, in a sense. But like, we're starting to see competition as a part of the ecosystem, primarily between layer ones at the moment. But as these right now we're seeing layer ones start to compete with each other in terms of TVL. And if we dig a bit deeper into each of those these layer one and protocol level ecosystems, the applications are starting to battle for TVL as well, kind of inter-chain. Initially it was Uniswap and SushiSwap. And when SushiSwap launched, you had the mass exodus over there as a result of the incentive programs. But ultimately, it was like a new brand on the scene that segmented from Uniswap, and also started to go multi-chain and compete with the native applications that you described. And it was something that we kind of saw early on, is the dichotomy between a reputable brand that legitimized itself probably on mainnet and then started to go multi-chain versus these native applications that were born on an EVM compatible, not a mainnet chain. And initially it was like, oh, this new L1, it's quick, it's cheap, it's going to be around forever, so this application is going to do great and it's going to be sustainable. But then you have all these layer ones that start to pop up. They all solve the same problem and provide the same level of scalability. And those native applications didn't have any merit anymore once the brand recognized applications went multi-chain. Sushi swaps on every chain. We're now even seeing Uniswap on Polygon, which I haven't looked too deep into the analytics, but I imagine a bunch of quick swap liquidity, hopped off, went over to Uniswap, and probably the same for other decentralized exchanges on Polygon. And the point being here, we're kind of seeing a consolidation in, all of these protocols that were able to kickstart a flywheel of their own through emissions are, kind of slowly drying up when the TVL isn't ballooning as a result of a bull market. So I think the choppy markets could provide kind of a breather for the ecosystem. The legitimate projects are going to continue to provide their real value and have a cash flow positive ecosystem that continues to evolve and probably enrich their token holders. But these native applications, I think Avalanche is kind of a story of its own. Like they do have like a bit of a maximalist kind of audience and community, but all of these other layer ones and ecosystems that don't have the stickiness that Avalanche or Mainnet or Polygon do could see their native applications start to dry up when we have legitimate, and I say legitimate, but really it's the cash flow positive applications that are starting to go multi-chain and capture TVL from those native applications.
Yeah, I mean, we actually launched it. Since we launched on BSC, we're actually not on a mainnet, which is rarity, right? Because we're one of the larger TVL protocols. We have over 1 billion TVL, and we're across the 14 different chains, but we're not on ETH. So that initially led to, I guess, a little bit of something to overcome, right? Like not being a mainnet protocol, and then having to legitimize yourself on all these different networks. And so, we've been able to do that, and we've been around for 1.5 years. So it's a lot easier. But you're right. Like a lot of these ones that launched on, let's say, Polygon or anywhere, Avalanche, Fantom, some of them are just like forks. They're just maybe touched up the UI, have a different theme. But the base contracts and everything are just like, forks of somebody else's contracts. So there's not really any innovation going on there. So, initially they filled the void, and the void was, hey, there needs to be some sort of decentralized exchange or a lending protocol on this network, and, Aave's not there, Uniswap's not there, SushiSwap's not there. So, we'll fill that void. But you can't just, you can start as a fork, and you should, like a lot of us did, right? Like, Beefy was initially a fork. But we've evolved and we continue to innovate. We have to find new ways to, create revenue. We have to be able to build on top of all sorts of protocols and create partnerships with, people to utilize the Beefy platform even more. I think you see a lot of these protocols that launched as forks, and maybe some UI enhancements, but if they're not really innovating and they're not building anything additional, then somebody else is just going to come and take that TVL, right? There has to be a reason to utilize your product over somebody else's. We actually created a new version of our UI, and what we're really trying to do is make it easier for retail investors to utilize DeFi. So we want to be able to give out as much information as possible. We have, on our new UI, we have historical APYs. So if you're going to invest in a vault, it's not just coming up and seeing the number, okay, well, this is, the current APY that is. You can actually go and look at a chart of historically how the vault has performed over the course of, let's say, a month or even a year, depending on the length of the farm. You can see the historical TVL. It'll let you know what the exact strategy is that we're utilizing in order to produce the yields. Gives you a little bit of information on each of the different tokens. So we're trying to give a lot more information, right? So you can make it a more informed investment as an investor, not only as a maybe newcomer to DeFi, but even as an advanced user. You don't have to go leave somewhere else to do your research. It's all right there. We're working with protocols to utilize our stuff, like I said, as collateral. We have a couple new other use cases coming that are going to be kind of fun. That are some traditional finance products that are not going to be able to utilize to build on top of Beefy. We're working on integrations to basically do fiat to vault in one transaction. So you can go from your dollars to deposit it in the Curve vault on Beefy, with one click. So we're continuing to try to find ways to make it easier to continue to innovate. We just released our Beefy Fantom over on Fantom. So what it is we purchased a validator, and we continue to run a validator. But we built a vault that basically perpetually locks and delegates Fantom to our validator to earn the maximum validator rewards, and then distributes those to the people who hold Beefy Fantom. So that's a consistent stream of revenue. One, we get the revenue from the delegations to our validator, but also we can produce the highest, basically, return on Fantom. So we're continuing to build new products and try to find new ways to generate yield. Beyond just farming, high interest emissions tokens, because eventually those are going to all dry up, right? So obviously we'll act on opportunities, and we've partnered with hundreds of protocols to be able to, help, drive TVL to their platform and optimize the yield. But we're also finding new ways to figure out how we're going to generate yield, how we're going to make it easier for users, how are we going to continue to give opportunities to utilize the Beefy application even more for other protocols, and how do we continue to interact? Maybe how can we interact with maybe other apps like. How can we get integrated into an app to make it easy so that you can just basically interact with Beefy on an app? So, that's what we continue. We're looking at how do we continue to move forward? So all these other protocols that have just kind of forked something and built something to fill a temporary void, if they're not going to continue to innovate, that's where you're going to kind of see, I think, the fallout, and it's going to eventually just dry up.
Yeah, and for anyone who might be dozing off towards the end of this, Weso just dropped an alpha tip by Fantom Beefy for the highest rewards on FTM, because the chain is not dead.
Yeah,
and
I think you can stake B Fantom, so it's BEFTM right now, and you can earn a 30% interest, and you can get paid in Fantom if you want, or you can get it auto compounded into more B Fantom. So yeah, we're that just launched like a week ago, so it's been pretty. I think we have like 7 million Fantom locked up in it now.
Nice. Yeah. That is a massive use case for interest bearing. You know, you're using the collateral as kind of stake validator collateral, but that can be transformed into collateral for several different use cases, as evident by 𝗵𝗶𝗴𝗵 Finance and their vaults over there, and self-repaying loans. Man, you dropped tons of alpha for the audience, man. Like, go get yourself a self-repaying loan on 𝗵. All right, 0% borrow interest, and it'll pay itself off because it's interest-bearing collateral. Go get yourself some Beefy Fantom, get some 30-35% APYs on FTM, and check out the new UI from Beefy, because there's confluence that you could identify when the historical performance of a vault is increasing and the TVL for one reason or another is decreasing. You would be getting more of the pool as you compounded if liquidity is leaving, and the pool, you can identify the performance and confirm that it's growing and it's continuously doing well. So yeah, tons of alpha, man. And I know we're kind of closing out here, running close on time, but we weren't gonna have this podcast, and I wasn't gonna bring up this question. We weren't gonna have this podcast without me bringing up this question. My final question is Beefy. Where did the name come from, man?
That's actually, I have no idea. So I came on as like an investor in like November. So Beefy launched in October of 2020. I came on and like I found it because I was playing around at BSC, and I was like, oh, this is amazing. Look at these fields. And so I was an investor and then a community member for a few months, and then I realized that you can actually, if you're a developer or you know how to develop it at least a little bit, you can launch strategies and then earn a portion of the harvest income as a strategist at Beefy. And anybody can do it. We're completely open source. We're an open contributor DAO, so we're completely actually run by the DAOs. The founders actually aren't even part of Beefy anymore. So anybody can come in and kind of contribute. And as a strategist, you can come in, deploy a strategy, and then you earn 0.5% of all the harvest yield for the life of however the vault exists. And so I was like, oh, that's I got to do a couple hours of work and then launch a vault, and I get this recurring income. Like, how cool is that, right? So I started launching vaults and
fast track to retirement.
Yeah, I mean, I'm just hey, this is the coolest thing. I could just and then you get addicted to it. You're like, okay, well, I got you start seeing the flows coming in. You're like, okay, now I spent a day launching some vaults, and now all of a sudden I see this consistent income coming in. And so then you're like, oh, I just got to do more. And then it gets you to keep going and keep launching vaults. And so I did that, and then I became an active developer and was helping. Really, my background's in business, so I was able to basically, I still do development work and still help Beefy in that regard, but really take on the leadership on the business strategic partnership side. And so when the founding team sort of left and left it all over to the contributors to basically take over, the whole initial thought of Beefy was to let it be completely run by the DAO. We have this transition phase, and now we have about 15 core contributors that are consistently running Beefy, from anything from marketing to develop to strategic partnerships to analytics, DevOps, graphic design. We have people that are doing it everything. So it's kind of cool. It's we're one of the, I think, few projects that ended up actually being a true DAO. It's interesting that Beefy doesn't have anybody that's currently a contributor that has any team share. So we're all actively pushing the product forward, and we get reoccurring contributor, I guess, essentially salaries. But none of us are it's not our own native product. It's just something that we believe in, and we want to continue to push forward. And so from that, I never really got a chance to ask the founders of why they named it Beefy. But yeah, I mean, that's the history on it.
Yeah, Solid, man. Yeah, it taps into the meme culture of crypto as a whole and Binance in particular. So, yeah. For everyone still listening, hop over to Beefy, check out the new UI, all the auto compounding on whatever chain you choose.
All of them.
And get all of the chains. Yeah, check them out on all the chains. And get yourself some Moo tokens for the memes.
Perfect. Yeah.
Cool, man. It was great having you on. Super great combo and learned a lot about Beefy and kind of how these layer 1 and layer 2 ecosystems are jump started. It was a blast, man. Thanks for hopping on.
No, thanks for having me.